India's retail inflation edged down slightly to 6.4% in February after reaching a 3-month high of 6.52% in January. However, the inflation print stayed above the Reserve Bank of India's upper tolerance level of 6% for a second straight month. Inflation in the food basket in February 2023 was at 5.95%, up from 5.94% in January. The food basket has a weightage of more than 39% in the overall consumer price index. Food and fuel prices are more susceptible to seasonal fluctuations. Therefore, what's worrying is that core inflation, which excludes food and fuel prices, is likely to remain sticky above the 6% mark. Meanwhile, growth in factory output or the index for industrial production recovered to a 2-month high of 5.2% in January, from 4.7% in December last year, on the back of a lower base and double-digit growth in the electricity output. The growth in electricity output accelerated to 12.7%, whereas manufacturing also recovered to 3.7%. According to data released on March 14, the US annual consumer inflation eased to 6% in February but remained elevated. This has added pressure on the Feds as it mulls further rate hikes to cool prices at its next meeting on March 23.
The RBI is cognizant that a certain segment of the inflation that they are talking about possibly may not be well managed by them in the first place, because that is a pure supply side shock that the economy is facing. And at the same time, there's a divisive MPC that you are seeing at this point in time, where two external members are anyway talking about the fact that one should understand and give time to the policy transmission lags, which could have implications for the economy 6 months down the line, and we may be ahead of ourselves in terms of tightening. So I think the debate will continue. The Indian economy is not firing all engines that you need to be very aggressive on rate hikes. 25 is the max that they would go ahead with, if at all they had.
With the Indian economy heating up and the Western pressure, is the Monetary Policy Committee planning yet another rate hike in its upcoming April meeting?
There's been a very sharp repricing of US Fed rate hike on the back of the financial stress that the banking stress that the economy is facing. And markets are now again divided whether Fed is going to probably even pause in the next policy, which is happening next week itself. And that again will have implications for most emerging market central banks, including that of RBI.
When will the new hiking cycle end, and what will be its major implications?
Right now, we are seeing very aggressive stance from the Fed. And I think on the domestic front also, as I said, inflation is still a concern. But what's also true is that growth is going to slow down next year. So my sense is that the cycle will peak at 6.75, the current rate hike cycle. 25 basis point is not going to make too much of a difference, I would say. So now the issue is that the transmission has been pretty fast this time, and almost all interest rates are above their pre-pandemic level. And so they will start gradually biting into the demand. So it will dampen growth a little bit, and by dampening growth, it will take some pressure off the core inflation.
Next year, we are looking at inflation coming off to a 5.2, 5.3% average, which is still higher than their 4% target, but significantly lower than their print for FY23. And more importantly, I think core will come down to close to 5%. That's still a tough call, but I think a lot will depend on how the US Fed really plays out their cards.
All eyes, therefore, are on the Fed meeting next week, even as the MPC prepares to meet in April. Experts say the Indian economy is not ready for an aggressive rate hike, irrespective of which way the Western banks lean. The RBI will have to strike a delicate balance.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.